It's quite annoying when you're so in line with the guest in terms of expectations that it's always quite like hard to ask questions. But I think that you touching like for me as a younger trader investor, it's sometimes hard to connect the dots, and I think you have been touching upon those points really well up there. Um, I think China is going to have a big impact, but if we say that China is constantly pushing money towards the US, what is like when is the time going to be that it's going to shift? And when it shifts, it's going to be a disaster for the US and probably for parts of Europe. What is that trigger going to be? As in, China has been doing those positive impacts into their internal economy, has zero impact. So probably they will continue to raise that.
Oh no, this is, I I believe this is quite straightforward.
Hmm.
Um, China has been pursuing its own self-interest, and it's the self-interest of the Chinese Communist Party. It is a fascist, undemocratic state. Now, lovely people, um, but they have been bribed with prosperity to look the other way. Um, and and so the policy, the foreign exchange policy, the undervaluation, the pursuit of economic growth externally via the export sector, um, will be supported for as long as it maintains the objective of at least 5% economic growth domestically in China. When that fails, they will give it up in pursuit of a policy which is better suited to the achievement of something which is impossible anyway. Okay, so, and I think that's what we're seeing.
Hmm.
We've seen them in the last 4 months. Their policy announcements show their concern
Hmm.
that their projections are most unlikely to be met. What we're seeing in the 10-year Chinese bond demonstrates vividly that the government is involved. Um, Now, the next point is, so most likely with everything with Trump is an exaggeration. So there's going to be 50% tariff on everything from China, and now maybe it's 5% or maybe it's
Yeah,
2.5%. Yeah,
or
um,
nothing, whatever.
or nothing. But um, but there were tariffs imposed under Trump one, which the Democrats retained, um, and they are essentially deflationary. So people again say they're inflation. So again, let's go back. Let's say Trump is true to his word and he puts on a 50% tariff. Okay. So what that means is the price of, I'm Walmart and I import, I don't know, $100 billion of Chinese product a year. And I'm going to have to, that $100 billion is now going to cost me $150 billion. And so my prices are going to, I'm going to add that to the price on Amazon. And so again, with the dismal science of economics, we say, oh, inflation. But it's not. That is actually impoverishment, because US wages ain't going to rise by 50%.
Hmm.
Yeah. And so again, you're going to get this malaise, and people are going to get frustrated, and they're going to keep electing kind of, uh, provocateurs who are sympathetic to their anger. It's not inflationary until you break with the Chinese break via the currency. Uh, there is a notion that now with the tariffs. So I'm not demonstrating this very well, but there is a very valid argument that any tariff can be circumvented by the Chinese by devaluing their currency.
Yeah.
And I don't dismiss that. That's very true. But it's deflationary. It's not inflationary. The economics of devaluing an undervalued exchange rate. So again, forgive me. Would you agree that the Chinese renminbi seems to be undervalued vis-a-vis the US dollar on not on a political basis, but on an economic basis? Would you agree with that statement?
I think, well, first of all, I'm not the biggest forex exchange expert, but I think so, yes.
Yeah, and the evidence would be that their trade surplus with the rest of the world is in excess of 1% of global GDP. And we have 150 years of data, and that's like 1929, it's like 1999, right? It's an extreme event that is very rare for any nation to have a surplus of 1% of global GDP. So it's very rare. And therefore, the supposition is the exchange rate must be undervalued. So if you devalue an undervalued exchange rate, nothing good happens. Why? Because your economic neighbors, they say, hey, get out of here. Like, you're killing us already, and now you've just had a competitive devaluation against us? No way. So the benefit from your exports is almost zero. And you're hoping to gain more from exports because if you devalue, then the cost of everything you import has gone up. And your household sector, they're not getting wage increases. And so again, they are impoverished. This is a really, really bad situation. So I look at, again, the frustration is, I can see the future. But when I look,
you can't pinpoint it.
Yeah, I do these dream manifestations, and I see it all clear, and then I wake up, and I'm like, I'm trying to rub it gets a little bit opaque. Which year? But I'm sure this year is very, very close. But maybe we get 2 more back-to-back incredible S&P years, or maybe the thing blows. But I think that holds the two together is, and to make it practical for investors, is I'd be looking for an ETF, an American ETF, that gave you exposure to the SOFR contracts, for the interest rate contracts for essentially where the Fed will be. So December and all the way out to June 26, you can buy those contracts around 96. And to let people understand the significance of 96, is bounded at 100. Where it's essentially 100 would be zero Fed funds rates. And the likelihood that America can go to negative rates, I wouldn't say it's impossible, but it's deemed to be less possible than than Europe, owing to the huge scale of money market funds. So the notion is, and you get a lot of leverage in those contracts, and you can buy options on those contracts. And if you're buying options, you've got to be selling options. So you'd want to essentially create an option package that said that the SOFR between December of this year and June of next year would trade above 98. Yeah, so you'd be kind of, if you will, because it's options, you've got to sell something, because options are always expensive. So sell something to buy something kind of allows you to take out the price premium in options. But you essentially want exposure to the notion of actual Fed funds rates being 2 or less than 2% between the end of this year and the middle of next year. That in itself, that will happen because they're bailing out the rest of the world, and it makes a bubble in US stocks, or that the whole world just tips on its ass and falls over. So I find the most comfort there. So again, all this job owning and fancy talk and nonsense, cutting to the chase, this 2025 could be quite a straightforward year. I'm positioned, we haven't mentioned it yet, but digitally, I find the only asset which has risk asset which has profound asymmetry to the upside is Bitcoin. I'm sure you'll be delighted to hear that. And so I've got an exposure there. I've got an exposure to a surprise, and my big surprise is rates. Rates are going to move a lot, and this is going to be a big deflationary year, and so I'm putting the two together, and I'm like, and as long as the S&P trades above 5,700, you know, the games and the merriment are going to continue. But you watch, if we lose 5,700, then things will become quickly more deflationary, and asset prices could be subject to quite a substantial devaluation. Boom.
During these markets, I'm always looking for opportunities to build my portfolio, and OKX is bringing you an opportunity. They are the first fully licensed exchange in Europe with the lowest fees. And to help you a little bit with your portfolio and to celebrate this milestone, they are giving away up to 50 euros in Bitcoin if you sign up today on the exchange. Signing up can be done within 5 minutes, and if you deposit 100 euros worth of crypto, you'll receive the first 20 euros in Bitcoin. Start rebuilding your portfolio today. Go to the link in the description or scan the QR code and enjoy up to 50 euro in Bitcoin.